Good morning, ladies and gentlemen, and welcome to the show on this Monday, the 22nd of November, 2021. Thank you for tuning in. Glad to have you guys here. Now, I'll tell you what, we got a lot happening in the news and finance right now. There's a few big things going on. One of the things is guess what? Well, let's open the charts and see. Open the charts right here. Biden is going to pick or select Jerome Powell for the new term as a Fed chairman. So it's Jerome Powell that's going to go in, not Brainerd. It's Powell. Brainerd would have been more dovish. The Fed right now is going into a very hawkish mode right now at this point in time. And I truly believe that this hawkish period or hawkish stance that's going on right now is going to last a little while. And it's going to be a giant pin. It's going to start to prick the bubbles. So get ready for this. This is coming in our immediate future, within the next 6 months. And it could turn everything in all of the markets very negative, very suddenly. And I expect that this could come on very, very suddenly when it happens. I think they're going to get away with their first tightening measure without too much ramifications. But it's going to be, you see how this works, guys, is it's accumulative. What they do is they put the first tightening measure in, and then the second tightening measure comes soon thereafter, and it's accumulative. In other words, the first is a little nip. You know, it's just like if you're cutting a tree, just putting a little gouge in the stump, you know. And the second one, they dig deeper and deeper and deeper. And they're going to keep going until they get to zero. Well, they're not going to be wrong until they're proven wrong. And I think when the proving wrong is going to come, it's going to come suddenly. And I think it's going to come swiftly. It's going to be a market reaction. I don't think they're going to be able to go all the way down as far as they want to go before they hit that. You know, and that's where we're going with this. Let's take a look now at Congress must clarify how the infrastructure bill will impact cryptocurrency. You have to understand something here. This $1 trillion infrastructure bill signed into law by President Joe Biden last week, it contains provisions that would tax cryptocurrency trades. It's supposed to yield the government some $2.8 billion a year. And, well, to be truthful, that's not a lot of money, guys. But the thing is these laws are going to be very difficult. And one of the reasons why is some of them are very transparent. Like if you buy a car using Bitcoin, at the time you use the Bitcoin to buy the car would be when you're taxed. That's easy enough, okay? And other parts, you know, like... But when you start to get in, like if you transfer your crypto into a smart contract and you're using it to hold an NTF that other people buy, all of a sudden things get really messy as far as tax is concerned. And it says it's running the risk right here of individuals dealing with taxes that have the complexity of corporate transactions. In other words, oh my gosh, you know, how do I deal with this? I don't know anything. And all of a sudden you're like into something that's the equivalent of a corporate transaction. I mean, it's just like they corporations, you know, they have teams of lawyers. They know exactly what things to file and what to do and what to do. And this is going to all of a sudden be coming on thousands of people who maybe are running these complex smart contracts and stuff and holding NTFs and stuff. Thousands of people who are not corporations, and they just don't know. I mean, they're just like, what on earth am I going to do? I got something that has the complexity of a corporate transaction. All of a sudden, they're like, should I hire a lawyer? What the heck am I going to do? Well, this is what the hammer's coming down, and so a lot of people might, you know, they might say, hey, you know, I'm not buying cryptocurrency. It's too complex to try to tax this and everything. I don't know how I'm going to deal with this. Or a lot of people that have it might just want to get rid. I just don't know. I mean, this is going to be just strange, you know. But another thing, you guys know from what I just told you, about 2 or 3 minutes ago, how the Fed is pricking the bubble. Okay? What do you think's going to happen when the stock market suddenly falls out of bed? And I mean it falls fast and hard. Well, there's going to be margin calls and things go out because an awful lot of people right now are bought on margin and stuff. So what are they going to do? They're going to sell their cryptocurrency account. What does that mean for cryptocurrency? A buying opportunity, because ultimately in the end, cryptocurrency is going to be massive on the other side of all this. And what we're going through is this little period where they're being tight. They're going to blow the whole thing open and just prick the bubbles. And then they're going to have to be loose again. So let's not look at the tight part. That's the part that's going to happen in the next 6 months or so. Let's not look at that at all. Let's look past that to the loose policy again. It's going to be coming on the other side of that. Right? That's what you need to do. You need to look past all that and see the loose monetary policy that's going to be coming and the amount of inflation that's going to be coming. Now, that inflation then, at that point, is going to be a self-feeding, self-perpetuating cycle. And it's going to really move fast, the inflation then. So there's going to be a massive wave of inflation coming, probably toward the end of 2022. So these are the asset classes you want to be in then. When that inflation comes, is cryptos, gold, and silver. That's where you want to be, out of the dollar. This is the dollar's last hurrah, and you're going to see that later in the show. I'm going to show you guys how the dollar's strengthening right now, even on the DXY against the other fiat currencies, which is what it's being compared against on the DXY. Okay, let's move on right here. Let's take a look now at silver. And look at this awesome smash this morning. It's bouncing back now, but this was a tremendous smash this morning. Look at this. The green goes straight down. Almost straight down it's been going. And it's bouncing back now. It went down to below $24.30 for a short period of time. It was in the 24.20s. Now it's bouncing back to 24.39. What's gold doing? Let's take a look here to see what gold's doing. Gold has had to smash too. It's down $26.80 at 18.18. It's trying to bounce back. Well, you know, when the smash hits, there it is. New York opened up. Need I say more, guys? The gold and silver manipulation is ongoing. Now, we do know that at the end of this year, not very long from now, Basel III comes into full effect. It doesn't seem like it's stopping them yet. Well, let's move on. Let's take a look at cryptocurrency today. 26.18. Cryptocurrency has been suffering lately. The Bitcoin price is at $58,669 today and 51 cents. Let's just refresh the page and see if it's going up or down right at this moment. If we refresh the page, it's at 26.18 right now. We refresh the page, 26.06, so it's going down right now. It's going down the elevator shaft right now. And, you know, I think that there's going to be a beautiful buying opportunities in cryptocurrencies coming up. When the Fed picks this bubble, when the Fed pricks this bubble. And I'll tell you, I don't think that you're going to see as big a buying opportunity in gold and silver, because gold and silver, they might not go down any. And in fact, they might even go up when the Fed pricks the bubble. But I think crypto is going to go down. And it could go down quite hard. You could see a buying opportunity like never witnessed before, because on the other side of this, now, remember I told you got to look on the other side of this? When the central banks have to step in, they're not going to let that stock market go below 20% fall. They're not going to let it fall more than 20%. They're going to step in. They'll do whatever they have to do. But it all involves printing money. So they're going to do whatever they have to do, and it all involves printing money. It means more money creation. On top of what we already got inflation. Investors are already getting nervous, guys, and saying, hey, you know, my money's losing value. What am I going to do? Why do you think cryptocurrency's up so high right now? Why do you think gold and silver's up? Well, not up as much as it could be if it wasn't manipulated, but it's up. It's because of all this money printing. And they're not going to stop. Because if they stop, if they even try to stop, which is what they're trying to do with this tightening, they're trying a little bit of whatever to try to haul the horns in. You know what's going to happen is the whole thing's going to start to collapse. And then they're going to run back in. What do we do? What do we do? They're going to run back in to support it with more money creation. This is not going to stop. This process is not going to stop. It's like an incoming tide. You ever watch an incoming tide? Sometimes there'll be a big wave and it'll move the tide up closer to where you are. You know, you're just like standing there. You know, I see a big wave come in, move. And then when it seems to recede a little bit again for a few minutes before an even bigger wave comes in. That's what's happening right now. We're seeing a little receding. But the overall trend is toward inflation. So this little receding could be a drop of 20% in the markets and stuff before the Fed says, hey, we can't let this fall to the floor. We got to support it. And they will support it. But we could see a 20% drop in the markets. And during that time, you could see Bitcoin drop down to, I don't know, 45,000. What a buying opportunity that would create. Because on the other side of this, when they come in with the big money printers, the money bombers, is what they're going to have to do, because this is going to create momentum to the downside. If the stock market falls 20%, it's going to want to fall 40%. It's going to want to fall 60%. It wouldn't stop until it's down around 80 or 90%, and the system would freeze. Because deflation wants to happen. It wants to happen so bad. But they're not going to allow it. They'll correct it. They won't let the whole system cave in on itself, because it's so over leveraged at this point, it would continue to cave and cave and cave until the whole thing would freeze. Basically, all the money is all debt created, and when the debts are expunged by paying off the debts, that's deflation. That's what happens in deflation. The system would go down to a certain point. I'm thinking if it dropped about 40%, it would freeze. It would just lock up. Wouldn't work, wouldn't function. They know that. They know they can't let this whole thing deflate down. Back in 2008, guys, they couldn't let it happen. They said it would be the worst disaster ever, and they had to stop it. We are so much bigger now than we were in 2008. They've like ballooned the system, like doubled the size of the balloon. If they couldn't let it pop in 2008, how in the heck are they going to let it pop now? The answer is they can't. Seriously, they can't let it pop. So, all this maneuver that they're doing right now is just going to set gears in motion that they're going to have to fix on the other side of this. But they only react when there's a problem. They're going to run face first into this problem, like a guy is running and he hits a brick wall. That's what's going to happen to them. They're going to run face first into the problem. The problem is the bubbles are going to start to pop, and then they're going to have to come in and fix it. And when they fix it, they're going to move us into the hyperinflation faster than they ever were before. That's where we're headed. And this is all going to play out rapidly. You see, we were in for a slow hyperinflation, slow movement into hyperinflation. If they just hold the course, hold the line right now, and don't do anything, let the machine run, it might take 2, 3, 4 years before we get there, with a moderate amount of inflation slowly increasing. But because they're going to come in and try to tighten, they're going to set this in motion much quicker. By messing with the machine, they're going to throw a monkey wrench into the gears, and then they're going to have to try to fix it, and it's going to be a mess. That's what's coming, guys. So it's coming. Let's move on. Take a look at the Dow today, and what we're seeing in the Dow is it's up 140 points. This is a melt-up before the big woohoo. Let's just whistle about it when it's coming. It's a melt-up, though. It should be a no-brainer to everybody out there. I read a thing on Zero Hedge this morning. It said nobody knows what the economy's going to do. This is not something that you have to be some sort of a clairvoyant to see. They're tightening. into a weakness in the economy, and at the same time, not only are they tightening into weakness, they're tightening into an overbloated stock market that's been in a melt-up for a period of time. This is a no-brainer. This melt-up could continue, for an extended, longer period of time if the Fed would just leave it alone. But no, they're stepping in right now. They're stepping in, and this is what they're going to do. They're going to prick the bubble. Okay, here we are. Let's take a look at oil today, 75.33. Oil looks like it's already starting to prick a little bit here. Down 61 cents on the day so far, 75.33. It was up over $80. I have to wait and watch and see what oil does. Oil is one of your leading indicators for the entire economy, including the gold and silver market, everything. The dollar index, everything. A lot of it's related to oil. This is an oil-based economy. Okay, move index today. 73.39 today and going along sideways. It's down a little bit. It's cooled off a little bit. It was hopping up over the 80 mark, which I consider to be instability in the credit markets. But now it's 73.39. Let's take a look at bonds and rates, and we're seeing bond yields climb. Now, we're going to have to see if this is extended for a couple days or whether it's just a one-day thing and then they fall tomorrow. We're going to have to wait and see if we get multiple days with the yields climbing like this. But it is substantial. U.S. 10-year at 1.58 and the U.S. 30-year at 1.94. U.S. 30-year, and we still have that inversion between the U.S. 20-year and 30-year. 1.978 on the U.S. 20-year. And 1.94 on the U.S. 30-year. So we still have a yield curve inversion. Okay, now for the dollar index to finish up the show. 96.44 and shooting to the moon on the DXY. Investors are seeing it right now. We're seeing a strength in the dollar because of what the Fed's doing, And they're hopeful that the Fed will be able to complete this tightening schedule and that the dollar will stay strong all the way through, and this will curb inflation. These are the hopes. These are the hopes. But these hopes are based on the Fed being able to go through all this and the market's not falling out of bed and the bubble's not all popping. And the Fed being able to taper right down to zero and the dollar gaining strength the whole time, and of course, investors are hopeful for the strength of the dollar. Okay, thank you guys for listening to my show. Like and subscribe. And we'll catch you guys in the very next episode. Bye-bye.